Hello, welcome back. I'm with David Garofalo, the Chairman and CEO of Gold Royalty Corp. David, thanks for coming on.
I'm delighted, Peter. Thank you for having me on.
Obviously, we've spoken about Gold Royalty a lot in the past, but I actually wanted to bring you on, given your expertise, actually talk a bit more about the gold market and the way that you're looking at things. Just to run things through, I think it's important for people to understand your background and your experience. So maybe just kick things off. Just tell us a bit about your history.
Sure. I've been in the mining industry for 35 years, principally with operating companies. Started my career with Inmet Mining on the base metal side for 8 years, then became CFO of Agnico Eagle for a dozen years. Ran Hud Bay Minerals for 5 years back on the base metal side, and then ran Goldcorp until it culminated with the merger with Newmont back in 2019 to create the world's biggest gold company by market cap and production.
Okay, a lot of history producing gold and working in the market then. How are you looking at the gold market right now? We've obviously seen a bit of hurt going on, especially today. Gold's at around, sort of trading around the 1920 mark. What's been the main cause of this? And I guess what's your thoughts at the moment?
Well, my thought is that actually gold in virtually every other major currency is at or near all-time highs. And so gold as a reserve currency, as really the only ultimate currency, has maintained its value very well in the face of rising nominal interest rates and is very close to all-time nominal highs against the US dollar as well, in spite of the fact that there's been a flight into the US dollar in the last little while as a result of treasury yields going up and also a lack of confidence in virtually every other economy in the world in this inflationary cycle that we find ourselves in.
What's your current view on the Fed and interest rates moving forward? A decision needs to be made fairly soon as to whether or not they'll hike rates again. Any thoughts as to what they might be up to?
Well, I expect they'll continue to signal that they're going to hike rates for a little bit longer, but I think they're really ending or nearing the end of the interest rate tightening cycle. And I think really what's driving that decision is the fact that there's so much debt at the global level. Debt to GDP globally is about 150%, or sorry, 350% versus 100% back in the 1970s, the last big inflation cycle. And so we're at a level where debt is not sustainable. It's not serviceable. In the U.S. alone, debt service is exceeded $1 trillion per year, which is one out of every $7 of tax revenue generated in the U.S. Another 100 or 200 basis points of tightening in nominal rates would double that again. And that's a doubling since the onset of the tightening cycle we've experienced in the last 18 to 24 months. So we're at really an unsustainable level in terms of debt service, not only at the government level, but globally, whether you're looking at the consumer level, the corporate level. There's just too much debt globally. And so as a result, I think what will happen is the Federal Reserve and central banks globally will start to pivot. And I think inflation is quite deeply entrenched, will remain entrenched for the foreseeable future, and necessarily so because there's no fiscally responsible way for these governments to repay their debt. They're going to have to inflate the debt away. So I do think that central banks are being somewhat disingenuous when they say they're tightening interest rates. They're really not, because inflation levels are far and above where the headline numbers are. And even though nominal rates have been going up, real interest rates continue to decline, which is why gold has held its value so well in the spite of unprecedented tightening in nominal interest rates, and will continue to do so because inflation is much more deeply entrenched than the headline numbers and the official statistics might indicate.
Like, what else could the Fed be doing? I mean, obviously, increasing interest rates seems to be their only playbook at the moment. Is there anything else that they could do?
I don't think so. I think that the die has been cast really since really back to the Alan Greenspan days when interest rates were lower for longer, and that was amplified during the great financial crisis in 2008. And we went through an unprecedented period of monetary expansion, and debt was cheap, money was free, and as a result, these excesses have worked their way into the system. And it's not something that's going to be unwound overnight. It's going to take many, many decades of unwinding, sweating off this debt. And the only way to deal with the debt, as I said, is to inflate it away right now. So I think the die is cast. I think we're in for a prolonged inflationary cycle. I think interest rates will continue to go deeper and deeper into negative territory on a real basis, which is really what's driving capital into gold, what's driving central banks globally to buy gold at unprecedented levels as well. I think the Chinese, the Russians, the developing world, the BRIC economies are realizing this is an opportunity for them to create an alternative reserve currency And the reason the US dollar sustained that for so long is because it has the biggest gold reserves in the world. And the Chinese, who are the biggest producers of gold in the world as a country, are consuming all of the gold they produce in their central bank vaults in consumer demand within China. But they're also the biggest importer of gold in the world. So they're diversifying into gold as quickly as possible, for the end objective being that they want to create an alternative reserve currency to the US dollar. And I think the US dollar has never been more vulnerable in that regard.
I think I've thought about the alternative reserve currency backed by gold before, but I think one of the main issues that I've always had with it is ultimately, if you're going to have a currency backed by something, you need to trust the people that are holding that reserve to actually pay out when you give them your check. I mean, do you ever see? In my mind, I can't really see it happening, but could you ever see it in your mind where the US dollar isn't the most stable and I guess the world currency, or where it is debunked in any way?
Yeah, well, I do think because of the debt level at the U.S. government level, and the fact that the Chinese are actually the biggest holders of U.S. treasuries, I think there is a vulnerability within the U.S. economy to that kind of diversification away from the U.S. dollar as a reserve currency. Every fiat currency that's ever been created since the beginning of time has ultimately failed because the temptation is too great for the creators of that currency to undermine its value, to debase it, and that's happened since time immemorial. And that's why gold has ultimately been a currency for 4 millennia, and everything else is eventually fallen away.
One of the things that you were talking about there, where any opportunity they get, they'll sort of debase their own value. Obviously, this Fitch rating being downgraded from AAA to AA plus, cost of borrowing increases for the US. I guess in my mind, it seems to be a new pathway to be printing more money for the US government. If the cost of borrowing money is increased, where else are they going to get new stimulus from? So I guess it seems to me that we're stuck in this cycle now of the US fighting interest rates, getting inflation lower. As soon as they're a bit lower, they'll print more money, and we're going to be in this endless cycle. Is that fair enough?
I think so, and it does go back to the absolute amount of debt that's been strapped on globally, and in particular in the U.S. economy. There is no, pathway to repaying that debt in any fiscally responsible way. There has to be a path to basically inflate the debt away, make it a smaller component of GDP by inflating GDP, by introducing systemic and entrenched inflation into the economy. I think it is here to stay. And when I see inflation numbers at 3, 4, 5%, I mean that's just fiction. It's economic fiction. Everybody that's listening to this today will tell you that their cost of living is going up double digit. If you're putting a roof over your head, food in your stomach, or fuel in your car, you're not experiencing 3 or 4% inflation. It's deeply into double digit territory. So the headline numbers can't be trusted. And that's why real interest rates are actually negative, and more increasingly negative, in spite of a historic nominal tightening of interest rates.
Something that was a bit more positive that came out yesterday, or Monday the 7th, was JP Morgan's chief economist coming out saying they're not expecting a recession towards the end of the year. We also had the US economic data come out saying 2.4% increase in GDP, which is higher than expected. That's good news for the economy, but potentially bad news for gold?
I don't think so, because again, I do think that interest rates probably topped out on a nominal basis, and I do think inflation is here to stay. So I think the gold price staying strong in the $1,900 to $2,000 an ounce range, not far from its all-time nominal high, and again at all-time highs in virtually every other major currency, tells you and that it's an accurate barometer of what's really happening on the ground in terms of inflation and cost of living.
How much do you underpin the value of gold to inflation rather than interest rates themselves? Because obviously, depending on how you look at it and how you're valuing it, that would then also, wouldn't it?
It's all part of the same equation. Ultimately, what I think drives gold up and down is less about supply and demand in a traditional sense of how commodities operate. It's more currency, and relative real interest rates is really what drives currencies up and down. And while gold yields zero, always has yielded zero, let's face it, virtually every other major currency, the treasuries in those major economies, are yielding negative on a real basis. And really, the opportunity cost of owning gold has disappeared as a result of that. And that's really, it's driving capital, maintaining capital into gold.
Wanted to move on to more of the actual production of gold. Obviously, it's an industry that you know very well. Um, Obviously, we've seen quite a lot of inflation, like you're talking about there. Inflation's embedded at the moment, and we've seen the ASIC of most of the global gold producers go up quite substantially. We're seeing profit margins shrink. That in itself, obviously, not great news for the gold producers. But something that's playing on my mind is this ESG theme, and I guess with more and more regulations coming in, and it's harder to permit, and the way that you have to build a mine is changing quite significantly, or it should do in the future, by the sounds of it. How profitable is it for people to be in gold mine? I mean, why would you want to be exposed to gold mining stocks in that scenario?
Well, I think it's telling that after 30 plus years of building operating mines, I'm running a royalty company today. I still believe in the bull scenario for gold. I think fundamentally it's a commodity that it's going to do extremely well in this entrenched inflationary cycle. But what I don't want to be exposed to is operating and capital expenditure risk. I think that that inflation that's entrenched in the general economy, well, mining companies are not immune from that. And so if you're building mines, operating mines today, it's never been more perilous from a cost standpoint. The costs are so fluid and fluid upwards that it's really overhung equity performance in the gold sector. With gold prices at these levels, you would have thought that valuations would be far and above what they've been historically. But the reality is we've seen valuations compressed by up to 50% across the operating space among the larger cap names. Looking at where it is today relative to where it was back in 2020 when gold was last through $2,000 an ounce. Look at some of the bellwether stocks, whether it's Newmont, Agnico Eagle, Barrick. They're all trading about half of where they were back in 2020 as a result of that compression of multiples. And I think that's really being driven by the overhang of cost inflation in the sector. Again, the sector is not immune from inflation that we're experiencing in the general economy. So, I've decided to run a royalty business because I want that top line exposure while insulating our shareholders from cost inflation of the underlying business. It's again a very perilous environment to be in from a cost standpoint, but also in addition, there's an existential threat from the lack of reserve growth. And reserves are down 40% in the gold sector from their peak in 2012. There simply has not been a sufficient reinvestment back into exploration and mine development to replace depleting reserves and production. And part of that is the fact that juniors have not had access to the capital markets on any sort of consistent basis since 2012. It's really almost been a nuclear winter other than the occasional period of 3 or 4 months where the juniors, have a window to raise a bit of capital, but it hasn't been consistent. And let's face it, the juniors are the ones that do all the heavy lifting on the exploration side. They're the ones that make the major discoveries. Ultimately, they sell those assets off to the senior companies that have the balance sheet and the technical wherewithal to build those mines out into productive assets. But if they're not discovering, the industry is going to shrink. And that's where we've seen since really 2018, almost a continuous M&A run in the sector. Because if you're not finding in the ground, you're going to have to buy it. And so I think you're going to see the industry continue to cannibalize itself, which, as you know, is a zero-sum game. Because if you're not finding ounces in the ground, as an industry, you're going to continue to shrink. And I think that's overhung valuation significantly as well. The industry has shrunk in value because ounces in the ground have shrunk.
In your view, obviously, we're talking about sort of gold equities there, producing equities or even exploration development, obviously not getting a lot of love at the moment. For yourself, I mean, how obviously I know what you're going to say is obviously royalties because you're running. There's
I'm going to talk my own book.
Yeah, but I think, and to be honest, I agree with that as well. I do agree that royalties are probably the safest option. But other than royalties, because we've spoken about that before, and I think I'm hoping everyone understands the appeal of royalties in terms of obviously having access to the bottom line without the operational risk and without the cost inflation as well. But what other ways would you suggest people would maybe gain access to gold? Would it be through ETFs, through bullion? For what? Obviously, if inflation's entrenched and it's a good opportunity, how do you best capture that opportunity? I guess that's what I'm trying to say.
Yeah, look, there's a variety of means to play gold. Unlike when I started my career, you'd had to line up the bank and buy the physical commodity and store it in a vault. Now you do have the ETFs. That's been the advent of the ETFs. I think has opened up the commodity to investment by institutional investors. The physical commodity back in the day, pension funds and mutual funds couldn't buy physical gold. Now through the ETF and the facilities of various major exchanges, they have the ability to get physically backed paper. And I think that's great. That's opened up a whole new horizon for investment in the physical commodity. And I think that's good for the sector. But it's also created challenges for the producers because if pension funds and mutual funds can buy physical commodities through the ETFs, they don't necessarily have to buy the producers. And so I think that's result in a bit of margin compression, or I should say multiple compression for the producers in the sector, even before we saw the onset of inflation and the havoc that's wreaked on margins in the sector in spite of a rising gold price environment. So that's one way to play it. You can buy the physical, you can buy the ETFs, you can buy the mining equities to theoretically get leverage to the gold price. Margins should expand disproportionately as the gold price goes up. But as I said, the producers are facing cost pressure, so that's kind of undermined the leverage proposition within the producers. But time and again, it's been demonstrated that the royalty companies provide that optimum leverage because they provide insulation from cost inflation with still upside to exploration success. Because as you know, the royalties are not just on the existing reserves, but any growth in the reserves that our operating partners realize through their brownfield exploration efforts. And so it's the best of all worlds. And we don't have to contribute those exploration budgets because once we own the royalties, we own them outright. There are never any capital calls on them. And we get the benefit of that exploration upside and the investments they make in their exploration budgets without actually having to contribute to them.
Yeah, one of the things I loved about your presentation when I last saw it was I think last year you had exposure to over 700,000 meters of drilling, which was completely already baked into what you already paid for in terms of the royalty itself, which is pretty nice, isn't it?
And this year it's over 600,000 meters and another $200 million of exploration expenditures by our operating partners, again, which we're contributing nothing to, but we get the benefit of that in their exploration efforts.
I want to move on to tech and in particular crypto around gold, because I've actually had a lot of people email in asking why I never cover this. And it's not my area of expertise, but I understand that you're fairly familiar with this topic. So how much easier, I guess, what's the future looking like for cryptocurrencies backing commodities? And what does that mean for the commodity space? Obviously, if it's easier for people to access and buy and trade, I'm assuming that's good news.
Well, look, I think in this blockchain world that we're in, which I think the blockchain is quite revolutionary in terms of driving out friction costs, transaction costs, driving out the middleman. I think that's all very valuable. I think it's doing wonderful things for procurement, not only in the mining industry but globally. And I think that's great. The advent of that technology, I think, is remarkable and will do wonderful things for our economy. And clearly, you need a digital currency in which to participate in the blockchain. And so I think there's value to digital currency from that perspective. But we don't need 8,000 digital currencies. And if you can introduce a digital currency with any barriers to entry, to me, there's no intrinsic value in that currency. There's no scarcity of value in that currency. Whereas gold is very finite in its quantity. It's very difficult to mine. It's very difficult to add supply. We add 2% globally to the collective supply or accumulated supply on the Earth's surface every year as an industry. And increasingly, it's becoming more and more difficult to add to that supply. We have a remarkable inelasticity of supply to price. So as the gold price goes up, we can't just flick a switch and bring on more gold supply in response to that. There's nothing preventing any entry into the digital currency world. So really, where is the intrinsic value in that? That's the challenge that I see. I could see intrinsic value in Bitcoin, given its finite quantity and the fact that, again, you need a digital currency in which to participate in the blockchain. But another 7,999 of those currencies, dog coins and whatever else are out there, and I'm sure I'm mispronouncing it. I mean, that's a Ponzi scheme. Yeah. And so I just, buyer beware, caveat emptor.
Agreed. David, thank you for your time.
Thank you.